The topic is general portfolio policy and the defensive investor. Basic characteristics of investment portfolio are usually determined by the position and characteristics of the owner or owners. At one extreme, we have had the saving banks, life insurance companies, and so-called legal trust bonds. A generation ago, their investments were limited by law in many states to high-grade bonds, in some cases high-grade preferred stocks. At the other extreme, we have the well-to-do and experienced businessman who will include any kind of bond or stock in his security list provided he considers it an attractive purchase. It has been an old and sound principle that those who cannot afford to take risk should be connected with the relatively low return on their invested funds. From this, there has developed the general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he is ready to run. Our view is different. The rate of return ought to be dependent or rather on the amount of intelligent effort the investor is willing and able to bring to bear the task. The minimum return goes to our passive investor who wants both safety and freedom from concern. The maximum return would be realized by the alert and enterprising investor who exercises maximum intelligence and skill. In many cases, there were less real risk associated with buying a bargain issue, offering the chance of a large profit than with a conventional bond purchase yielding about 4.5%. It had more truth in it than we ourselves suspected, since in subsequent years even the best long-term bonds lost a substantial part of their market value because of the rising interest rates. So what are the basic problems of bond or stock allocation? We know briefest form of portfolio policy is the defensive investor. He should divide his funds between high-grade bonds, high-grade common stocks. It is a fundamental guiding rule that the investor should never have less than 25% or more than 75% of his fund in common stocks, with a consequent inverse range of funds between 75% and 25% in bonds. There is an important implication here. The standard division should be equal to 1 or 50-50 between the two major investment mediums. According to a sound reason for increasing the percentage in common stocks would be the appearance of the bargain price level created in the protracted bear market. Conversely, sound procedure would call for reducing the common stock component below 50% when, in the judgment of the investor, the market level has become dangerously high. This maxim have always been easy to enunciate and always difficult to follow because they go against that very human nature which produces that excesses of bull and bear markets. So it is almost a contradiction in terms of to suggest as a feasible policy for an average stock owners, and he lightens his holdings when the market advances beyond a certain point and add to them after a corresponding decline. It is because the average man operates and apparently must operate in opposite fashion that we have had great advances and collapses of the past, and this belief we have likely to have them in future. If the division between investment and speculative operations was so clear now as one it was, we might be able to envisage investors as a shrewd, experienced group who sell out to the heedless, hapless speculator at high prices and buy back from them at depressed levels. So this picture may have had some verisimilitude in bygone days, but it is hard to identify it with financial developments in recent periods. There is no indication that such professional operations as those of the mutual funds have been conducted in this fashion. The percentage of the portfolio held in equities by two major types of funds, balanced and common stock, changed very little from year to year. Their selling activities have been largely related to endeavors to switch from less to more promising holdings. We have long believed the stock market had lost contact with its old bonds, and if new ones have not yet been established, then we can give the investor no reliable rules by which to reduce his common stock holdings towards 25% minimum and rebuild them later to the 75% maximum. So we can urge that the general investor should not have more than one half of the equities unless he has strong confidence in the soundness of the stock position, and it's sure that he could view a market decline equanimity. So it is hard for us to see how such strong confidence can be justified at the levels of existing years. We would counsel against a greater than 50% apportionment to common stocks at this time. So for complementary reasons, it is almost equally difficult to advise a reduction of the figure well below 50% unless the investor is disputed in his own mind about the current market level and will be satisfied also to limit his participation in any further rise, say 25% of his total funds.